Hello, everybody. My name is Richard, and I'm the Sales Director at Inoxico Credit Bureau. I'm going to be looking at a couple of ways to help you guys with regards to trying to create competitive advantage in your environment. It's absolutely tough out in the big world at the moment. Most businesses are struggling to find good quality new business, companies that can pay them on time. Companies are struggling from a cash flow perspective, and companies are struggling from a profit margin perspective. But there is light at the end of the tunnel. Through workflow automation, data analytics, and technology, there's some very, very clever ways that we're helping our clients perform better than their competitors at this time. Just in terms of an agenda, I'm going to go through a couple of PowerPoint slides. I don't want to bore you to death with PowerPoint, but maybe just unpack a couple of challenges faced by companies at the moment, and then a brief little overview of Inoxico. Then what I want to do is give you a live demo on two solutions that we're offering our clients at the moment that's really, really helping them onboard better quality customers in a very quick time. We started to help them from a cash flow perspective, and we're helping them start to improve profit margins. So I'm just going to share with you a PowerPoint slide quickly. I'm going to make this bigger. There's it there. Cool. Sorry, got a new laptop. My laptop was stolen on Friday night. Okay, cool. Just a bit around Inoxico when this comes through. Okay, we're having a bit of a technical issue here sharing the screen. Cool. So who is Inoxico? Inoxico thought leaders in business-to-business credit risk management solutions across Africa, assisting companies to improve cash flow and make more profitable credit decisions. We achieve this through understanding our clients' unique needs and offering customer-specific solutions. So from an Inoxico perspective, we don't necessarily take a one-size-fits-all approach to our clients. We like to consult, and we like to understand the unique challenges that our clients are facing, and then we develop solutions specifically for their environment. Just a bit around Inoxico. We were founded in 2007, and the business started off by researching or doing due diligence on companies in Africa. We've got a branch in Kenya. We then branched out into supplier risk management and then into credit risk management. We've currently onboarded a lot of big businesses from a credit risk management perspective, the likes of DHL, Globeflight, Altron, Liquid Telecom. So some really big businesses that we're doing some fantastic things for. From a data perspective, we currently research just shy of about 6,000 companies on a monthly basis on behalf of the trade credit insurers. Given the fact that we do credit risk management as well as supplier risk management, our database is truly comprehensive, and there's no other bureau that can compete from a data perspective because we do risk management from a supplier as well as a credit risk management perspective. Good. Unpacking the credit challenges in the market. Cash flow management, major issue at the moment. Every single one of my clients are wanting to know how do they start to improve cash flow. The challenges that companies are faced with: extended collection days, debtors are paying them late, inconsistent cash flow, inaccurate forecasting because they really don't know which debtors are the good nature and who are bad, and outdated knowledge of best practices. And that's pretty much why I'm talking to you guys today. I'm going to try and share some best practice that can help you start to manage a far more sustainable, profitable business. Manual processes, manual is dead. Emmanuel died. Okay, so it's all about technology and workflow automation and doing things quicker, smarter, faster. So when one looks to automate your credit processes in your environment, you really start to create and to gain competitive advantage over your competitors. From a manual process perspective, typically right now, we get a manual credit application. We need to manually check the information. We need to manually pull a credit report. We need to manually make a decision. And all of this takes a hell of a lot of time to do. So when one starts to automate that and you put decision engines and analytics in place, you really start to do things quicker, smarter, faster. Credit policy, wow, that's a big one. if your credit policy right now looks the same when it did at the end of last year, you need to change it. Okay, credit policy needs to be aligned to the current market conditions that we're facing. So do we become more restrictive with regards to taking on new business? What are the levels of data information that we require to make an informed credit decision? How frequently do we review our debtors? How do we know which of our debtors are performing badly out in the marketplace, et cetera, et cetera? So credit policies really need to be fine-tuned and tweaked to the current economic environment. So we have an expert at Inoxico. He's a very high-level credit manager, and he's written a generic credit policy. So if anybody needs help with credit policies, please just give us a shout and we can design something specifically for your environment. Budget, time, and technology, those are massive issues at this point in time. Spare cash available to do really cool things. So one needs to really understand from a return on investment perspective and from a cost to benefit point of view, anything that you're doing in your environment, is it adding value? Is it saving time? Is it making me more money? Those are really the issues that you need to focus on. Cool. So looking at de-risking your cash flow, you need to map out your credit policy and your credit processes. So in other words, when you look at your typical debtor portfolio, what is the average size of a small, medium, and large account? Okay. And from a cost to benefit point of view, each one of these risk value breaks need different types of information to make an informed risk assessment. But if you have a small exposure of 20,000 Rand, you're not necessarily going to spend 700 or 800 Rand on information to make a risk assessment at that exposure. But you are probably going to spend 150 bucks because you want to verify if the company exists. You want to see how long they've been trading. You want to see how the directors of those companies are managing other businesses. You want to see whether those companies have judgments. You want to see whether there's been liquidation applications. And that's all sort of public source information which resides on our online database, so you can make an informed risk assessment at a fair price. And as those value breaks start to increase, if it's a 2 million Rand application, you're going to need far more intense research data to make an informed risk assessment. That means that Inoxico typically would be researching that company for you within our research environment. And we have about 65 researchers that sit here and research companies on behalf of all our clients. Then there's the big one around aligning your credit policy with your sales and business strategy. Often I say to credit executives, have you had line of sight of your credit policy, of your sales strategy? And the answer is no. And then I speak to the sales director and I say, right, have you had line of sight of the credit policy? No, we haven't. And then there's the business strategy. So the business strategy is typically, let's say I'm going to new markets, I have new products, I'm taking on new risk, et cetera, et cetera. But the business tends to forget to tell credit so that credit can update their credit policy accordingly. Business may say, right, I want to chase market share. I want to go to new markets. So therefore, we're probably going to take on a bit more risk and we're probably going to take a few bad debts here and there. We're going to sacrifice some margin, but we're going to gain market share. Again, everybody forgets to tell credit. And exactly the same with the sales strategy. So it is so important in organizations that between sales, credit, and business, that everybody understands from a policy and a strategy perspective who's doing what. Otherwise, everybody starts to sort of move off in different directions. Sales becomes frustrated with credit because sales throws an application form over the fence. Credit then has a look and declines it and throws it back. And then there's a whole lot of friction in the organization. And the only reason that happens is because these departments are not really talking to each other. Okay. How else do you de-risk your cash flow? Consult with an experienced cash flow consultant. At Inoxico, we typically don't employ average type salespeople. We employ people that have really great credit management knowledge as well as financial management knowledge, because we can then consult with our clients. And you also need to understand the various cash flow enhancing mitigation alternatives available. So yes, there's credit bureau solutions. There's alternate funding solutions. My background is I come from trade finance and debtor finance. And I would imagine within this environment now that cash flow is a massive problem. So maybe trade finance or debtor finance could be something to look at, or even asset finance. So if you need to know more about the lending alternatives, please feel free to give me a shout later in the day and I can chat to you about that. Then there's trade credit insurance. Trade credit insurance, in my experience, has always been a grudge purchase. It's expensive. Well, yes, relatively expensive, but relative to what? When you take a bad debt and your biggest debtor goes belly up, from an impact of loss point of view, if your biggest debtor goes belly up, are you going to close your doors? So those are the big questions that you need to ask. So if if you have really good GPs in your business, if I could choose, if I had my own business and I could choose, I would manage risk with credit information and I would have an umbrella over that. So from a catastrophe perspective, I would have insurance if GP margins allow that at the end of the day. So it's always an option. From a trade credit insurance perspective, there's really two types. You get full book. So in other words, a trade credit insurer will give you a slightly better price if you insure your entire book because their risk is spread. But if you're looking to insure 2 or 3 debtors, the price will be slightly inflated because therefore their risk starts to increase because there's not a good spread from that perspective. Then there's self-insure options. You can create a kitty where you put some money in every month just in case something goes belly up. Then there's collateral. I often speak to businesses and say, are you able to obtain any type of security or collateral? It's not always easy. If you're in a very competitive industry like freight forwarding, you're probably not going to get collateral for any type of exposure. But if you're in a very niche industry, you probably could then start to ask for some type of security, cession of debtors book, covering bond over property or whatever it may be. And then there's collection agency opportunities. A lot of my bigger clients have written off bad debt and I've said to them, right, so let's go and claw that bad debt back because it's not necessary to write that debt off. There are very, very credible EDCs, they call them, external debt collectors that do business to business collections on a no collection, no fee basis. And they are quite effective. So they don't have baseball bats. They really just build a collection strategy. They really got great people on the phones, people that are experienced in credit management. And I have a very large client in the gas industry that was forecasting to write off or provisioning to write off 85 million Rand. And we handed this collection mandate over to Transaction Capital and they collected out 75 million of the 85 million that this big gas company was provisioning to write off. So there is a really, really cool opportunity to get some money back. Then construct a more accurate cash flow forecasting model. We all know that IFRS 9 from an accounts receivable bad debt provisioning perspective, that the regulation around that is starting to become complex and more intense. So what the auditors require is that you put forward a bad debt provisioning forecast with regards to accounts receivable, taking an historical view and a future-looking view. We've developed 3 different models for our clients. So some clients take 2-3 days to prepare their bad debt provisioning. We have a model. They give us their data. We run the model. It takes a couple of hours for us to do that and saves our clients a massive amount of time where they can use that time and energy on managing other things in their business. Then to automate the entire credit process, I'm going to be taking you through our automated credit application solution. And this is where you can create massive competitive advantage for your business. I have some large clients, and I don't want to say who they are, in a very competitive industry that are making credit decisions in 30 minutes. So in other words, their competitors don't stand a chance. So the entire credit application process is automated and it really makes it quicker, smarter, faster for the sales guy to actually conclude that process with the prospect in 30 minutes, which is absolutely groundbreaking stuff. Cool. So where does Inoxico start to add value within the credit risk lifecycle? Verify and vet. A lot of people say to me, Richard, where does the credit risk lifecycle start? And most companies think the credit risk lifecycle starts with the day that a credit application form lands on your desk. I don't believe that. I believe that the credit risk lifecycle starts the day a sales guy goes to knock on a prospect's door. So if you could send your sales guys to better quality prospects, everything starts to improve thereafter. So when I give you the demo on our automated application system, you're going to notice that the automated system starts with the sales guy. So if the sales guy has 20 names that he needs to prospect, we've built some initial due diligence criteria into the system. The sales guy plugs the names into the system, and out of the 20 names, it's going to spit out 10 and say, these 10 are really bad. Don't even focus on them because they look like historical applications that you've declined. Focus on these 10 because they have a lower risk nature. So all of a sudden, the sales manager is getting better bang for his buck because the salespeople are going to see better quality businesses. The other thing is from a new business origination point of view, it's expensive. And often a salesperson goes back to a prospect 2, 3, maybe 4 times to complete the application process. The prospect may have forgotten to initial page 3 or whatever it may be, forgotten to include bank statements in the application. So I've done some research, and the average cost of a single new business call for the sales guy getting in the car, going out there, petrol, etc., salaries, commissions, etc., is anything between 500 and 3,000 Rand a sales call. So how I built the system is that the sales guy will only go and visit the prospect once. And if they're not able to conclude that application process, when they get back to the office, they open up their laptop, they can then physically see the application remotely. They can then phone up the prospect and say, right, I see that you haven't done this and this and this. You need credit. Please complete the cycle and send this back to our credit department. So all of a sudden, from a cost to benefit point of view, you're starting to save a lot of money around sales expenses. And credit control is then very happy because they only get applications back when they're 100% complete. We've also developed decision engines for smaller exposures. So in other words, if a small exposure in your world, typically, let's say it's under 50,000 Rand, we've built an automated scorecard and decision engine that will automatically approve, decline, or refer those exposures. So you're saving credit control time, having to manually go and do that. So there's massive value from an automation perspective. Okay. Then from a monitoring perspective, I'm really, really proud of what Inoxico has done from a data analytics perspective. We're helping our clients from a cash flow forecasting perspective, really starting to understand, if we look at your ledger, which debtors are the low, medium, and high risk sort of category, okay? We have tons of data that our clients don't know about from their debtors perspective. So in other words, we collect data all over the place. We then take our client's debtor master file, we run it through our database, and the algorithm will then interrogate each of those debtors and spit those debtors out into categories. So from a forecasting perspective, if we're telling you that these 20 debtors on your debtors book have become high risk because the directors in that business are running their other businesses into the ground, the directors have judgments, the company has judgments, there's been a liquidation application, there's been negative listings on our database, etc., we will then tell you why we're saying those businesses have become high risk. Then you can start to manage your risk accordingly and say, well, maybe I'm going to look to start to reduce my exposures, or I'm going to go and visit the guy and, say, it's come to my attention that your business is not performing that well anymore. We need some type of safety net. Can we have a session over your book or whatever it may be? Then the converse of that applies. You can have a large part of your debtors book. Typically, that could be a low risk. So you take those low risk customers and you say to your sales guys, take these and please go sell more to these guys because they have the ability to repay us on time. Okay. Then from a collections perspective, I partner with two very, very credible companies. The one is a very large listed company called Transaction Capital Recoveries, and they have a great track record in collecting debt, outstanding debt. Very credible professional guys. And then the fourth part of the credit lifecycle, which I made up, I called it Protect, and that's really around trade credit insurance. So that's typically the credit lifecycle, and those are the areas where Inoxico focuses, and Inoxico sometimes uses partners, but we offer end-to-end solutions throughout the credit risk lifecycle. Just a quick little slide here around time and effort. So if we look at those pyramids, on the left-hand side at the bottom, if you don't spend enough time vetting new clients and doing a proper due diligence, your collection effort becomes harder at the top, okay? If you look at the right-hand pyramid, if you apply a lot of time and energy in risk assessment, your collection effort becomes far easier at the end of the day, okay? I know it's not always easy, because the sales director walks into a credit manager's office and says, approve that deal. It's part of the strategy, et cetera, et cetera, et cetera. And you're sitting with information and you know that you shouldn't be approving the deal, but you're under pressure to do so. That's why it is so important for sales to have line of sight of the credit policy and for credit to have line of sight of the sales strategy. Because when you know what each environment's doing, you tend to start to work together as opposed to sort of pushing off in a different direction. Credit policy automation with Fabric. This is what I'm going to give you a quick run through now. Is the automation side of things. And we've really developed this tool over time. It's a generic standalone tool. And a lot of our clients have helped us enhance this tool. So it really caters for absolutely every instance, typically within the credit environment. Okay. So I'm going to shoot out of this PowerPoint presentation and I'm going to give you a live demo on our automated credit application solution. When you have a look at what I'm doing, the credit application form that I'm going to be using in this live demonstration, it's a web-based platform, is just an example. We take our client's credit application form and we put that into the system with your terms and conditions. We then apply your credit policy and your credit rules to the system from an exposure point of view. what information is needed at what sort of exposure level. Okay, so let me quickly nip out of this. Are you watching there, Fatima? Can you see? Is it fabric? Okay, cool. So this is our workflow system. And you can see that our workflow solutions are from sales pre-vetting to credit application and supplier vetting. So we are very strong in supplier risk management. We've automated supplier onboarding processes for the likes of Liberty, Momentum, etc., where it really makes it a lot easier where larger businesses are assessing risk from a supplier perspective. Then if we look at sales pre-vetting, this is the example that I spoke about earlier, where a sales guy typically would have 20 names and need to check them out and to start a credit application process. Then from a review point of view, let's say a customer wants to apply for a bigger credit limit. All you do is you go into the credit application side of things, you fire off an automated link to the prospective new client. It pre-populates with all the information that we have on file on that client. They then digitally sign it and send it back. Okay, so it's really quick, smart, fast, tech-driven, making life a lot easier for yourselves, as well as making life easier for your customers and your prospective new customers, which then is going to help you win business. So let's kickstart with sales lead pre-vetting. And this is typically what now a sales guy would be faced with. I'm trying to think of a company's name quickly. Let's just stick in as an example. So I'm the sales guy and I want to prospect on a Monday morning and I want to check things out. Huge telecoms as an example. Okay, it doesn't seem to like huge telecoms. Maybe that's not their name. Let's try this one. Okay, so I'm the sales guy. This is the business that I want to prospect. I click on it. Now what it's doing in the background, it's running off and it's conducting a due diligence upfront on this business. So it's looking at some criteria and it's now going to tell the sales guy whether this business is actually worth prospecting or not. Okay, let's hope that we have a stable connection. Cool. So you'll see there, that's the business name. They're in business. And in this instance, for this example, we're looking at 4 risk checks. There are up to 8 different risk checks that you can use. My view is always that you don't really want to be too restrictive. You want to look at some high-level risk criteria. But if you start to become too restrictive in looking at too many variables, your sales guy is going to have no leads to really prospect at the end of the day. So what we've done is we've checked that this business is in a valid state. They've been doing business for more than 12 months. They're not an existing customer of yours, and there are no active court notices, so no liquidation applications and no judgments. So there's no reason why the sales guy shouldn't prospect this particular business. Okay, so start prospect. Now, you must just bear with me because I'm going to play 2 roles quickly. Can you see what I'm showing you? Okay. I'm playing the salesperson as well as the prospective client. So I just need to open up a separate email box to show you what the client is now going to receive. Can you see the emails? Not yet. Okay, this is where it fails. So let me quickly share it again with you. Technology is great. Can you see it? Cool. So now what happens is that sales lead is now sent to the sales guy's inbox. So when the sales guy is sitting in front of the prospective new client, he would now have the application form. So Richard is now talking to the prospect and he's done a needs analysis and everybody's falling in love. And the prospect says, great, I need to fill in a credit application. The sales guy then says, cool, I'm going to make this process very, very simple for you to do, sir or madam. Start credit vetting process. Now what's going to happen is the application form is going to open up on the sales guy's laptop, desktop, okay? And the sales guy really needs to follow two quick processes. So they need to confirm the customer information and they need to confirm the credit limit that the prospective client is applying for. You'll see, now this in your world would be your credit application form, but you can see that it's already pre-populated with all of the pain in the rear end type information like reg number, VAT number. So this is where often, and especially SMEs at the end of the day, the guys are busy, they're running around. Now, a typical sales guy puts a 6-page application form down in front of the prospect and they want reg number, VAT number, etc. Now they start scratching in filing cabinets trying to find this information. Now it's much better because it's already pre-populated on the application form, and taking into consideration that we get a daily download from SIPC at 6 o'clock every morning, this information is absolutely 100% correct. So there's no room for error and mistakes. Okay, so now the sales guy just needs to confirm who is the person that they're talking to. Okay, and let's just say it's John Doe. Email address. And the contact number. Continue. And then he says, right, so what are the, cool. So what are the payment terms? The payment terms that we have structured in the system are 7, 14, 21, 28, 30, 45, 60, 90. We've also got cash in advance and we've got COD options as payment terms. It's all already set up. So just remember that the example I'm showing you now is just an example. So let's say it's 30 days, credit limit requested, 5,000 Rand. It's rands. And this is where credit policy now starts to take effect. So we would then build your policy to say, right, what is a small, medium, and large exposure in your world? And then what type of credit report would you require in order to make an informed risk assessment? So in this instance, we're having a live demo. So I'm just doing things manually, but this would then be built into the system. So it won't be the sales guy choosing the credit report. It will already be written into the system. So in this instance, it's 5,000 Rand. I'm going to say I want just a fast assessment. So in other words, it's going to look at Inoxico's online on-file database, and it's going to bring you back the credit report that we have on file. Okay, cool. Now what the sales guy does, he initiates the process. And now two things can happen. So firstly, if a bank code still means anything to you, you're going to save a couple of days on waiting for bank codes because it's already now automatically sent off the bank code request. And this is while the sales guy is still getting the application completed with the prospect. So that's really cool. And the second thing it's doing is it's doing a bureau knock and it's pre-populating the application form with all of the information that we have on file on that company into your credit application form. Okay. So when the prospect gets notification that this is real time across the desk, they open it up. That frustration of filling in all the nitty gritties is taken away because it's pre-populated. So let's go and have a look what the prospective client would be receiving. Now remember that this would be branded according to your environment, and it would be your credit application, and you would now be telling the prospect whatever you want to tell them. The bottom line is they now need to complete the application form. Okay, cool, that's who they are, and you basically tell them whatever you want to tell them. And now the prospective new client starts to complete the process. You'll see the sales guy already filled in that information. And you'll see the statutory information already is there. You'll see that the registered address of the business is already there. One of my clients asked us to develop a geotagging or geopinning ability, and they're in distribution. So in other words, you can click on find address on map and it will geopin that exactly where that business is. So if you've got trucks that are on the road, et cetera, you can give them the exact pin of where that business is. So that's a really cool functionality to have. And that another client paid us to actually do, and now everybody gets the benefit of that. All the information is there. Contact details. Let's just move along. I just need to click through this. Bank account information. if they need to upload their bank statements or management accounts or whatever it may be. Tax information is already there. Cancel that. Why is it asking me for that? Let's just say this is pending for the sake of this demo, save time. If you needed your prospective client to attach financials, there's ability to do that. And now we look at key management. So because we get the SIP-C file every day, we're now listing all the directors of that particular business. And let's say the person that's going to be signing the application form is not a director of the company. They would need to upload a board resolution into this environment before they could proceed. All right, now we get to the part of signing the agreement. So our digital signature, we took a long time to refine it and to make sure that it can stand up in a court of law. We took international best practice, and we then tested the digital signature with a couple of our global clients. So DHL is one of our clients, and their global office, sort of said that the digital signature and how it's set up is pretty cool. And the likes of Altron also agreed that it's valid, it's a good thing. So now we just need to confirm. Are you authorized to enter into an agreement? Let's say yes. This now would be your terms and conditions. And you confirm, you consent, you agree, and you now sign the agreement. Okay, so from a security perspective, an OTP is now sent to the person that's going to be signing this agreement. Let's just go and grab it. So just bear with me because I'm playing two roles here. And we stick in the OTP and we sign. Okay, cool. Now, if you want to view the signature, if you have a QR scanner on your phone, you can take a quick QR scan of that code, and then you would have the signed terms and conditions on your tablet or your phone or whatever it may be. And then if there was ever a dispute and you had to go to court, here's all the IP information of the person that actually signed this application form. You would then have sort of history. So let's say an admin person completes the application form, and in the background, they then sent that to the CFO to sign. The historical information would then show that that was the case, but the CFO was the person that finally signed the agreement. Okay, and we go next. And we now want to submit the application. Okay, so just dependent on how intense your application is, your sales guys could potentially complete the application process with a prospective client in 30 minutes. Okay, and this is really groundbreaking stuff. I've seen a couple of big companies winning massive competitive advantage out in the marketplace purely because they're making life for the prospective new clients so much easier to engage. And the relationship between credit and sales has started to improve because credit no longer gets incomplete application forms back in their environment. So I'm just giving this a bit of time because what it's doing is it's now running off and it's fetching the appropriate credit report because it's now going to deliver to your credit control environment the completed credit application, the signed terms and conditions, as well as the credit report, and then a suggestion in terms of score. Okay. At this point, you could choose to now build a decision engine for all smaller type exposures. So what it would be doing if it was a small exposure, let's say under 50,000 Rand, it would now ping our database. It would then hit the scorecard, and the algorithm will then interrogate that particular opportunity, and it will spit out an auto-approve, decline, or refer, so that the credit person on the other side doesn't now have to go and manually do everything. So I would suggest that decision engine for smaller type exposures because those are typically where the higher volumes of credit application forms come from. So let's see what's being delivered to credit control. It's now knocking on credit control's door and it's saying that you have a credit application to view. And let's view the result. and it's saying, I'm going to give you a decision now. All right, cool. So here's the signed terms and conditions. Now it's done a quick risk assessment because that's what I asked for initially. We see that the business is a score 1, which is a low score. If we wanted to view the full application, remembering that this would be your credit application with your branding, etc., etc., etc. So this is an example. So there's a physical copy of the credit application form. Some of my clients still want the ability to be able to print this stuff. I have no idea why, but they still like paper. So we have built that in the background. You can print this information and you want to quickly view the credit report that was on file. Remember that this is just a fast basic report that we asked for. Okay, cool. Having a look at this information, 5,000 Rand over 30 days, low risk, score 1. I will approve this application. Yippee. Approve it, boop, and off it's gone and resides in the cloud. At this point, the customer or the prospective customer who's now become a customer will get a notification to say your application has been approved, and the sales guy will also get a notification to say the application has been approved. Okay, so this is really quick, smart, fast way of doing business, and these are the kinds of things that one can do to start to create competitive advantage in this really, really tough economy. Okay, you've got to be smarter, you've got to be quicker, you've got to be faster than the competitors to win quality new business. Cool, so I'm just going to close this. I just want to get this ugly thing away here. Can I move this? Yeah, let's move it there. Are there any questions with regards to what I've just shown you before I get into the risk analysis tool? No questions? Am I not seeing any? No questions? Everybody can hear me? I hope everyone can hear me. Can somebody just say yes? Okay, cool. Awesome. So something I don't want to bore you to death with now, but I just quickly want to give you a demonstration on our risk analysis dashboard and what this risk analysis dashboard does. It gives you a 360-degree view of risk on your debtors ledger. So far too often I talk to clients and I say to them, right, let's look at your debtors book. Where's your risk? Oh, my risk is my 90, 120, and 150 days. Yeah, could be. Those are just guys that are paying you late. But how do you know what the real risk of those companies are? And this is where we developed the risk analysis dashboard. And what this tool then allows you to do is, let's say you have 10 debtors that make up your 120-day exposure. You need to be able to see, of those 10 debtors, what is the risk profile of those companies? So in other words, 5 of them could be low risk, but they're just choosing to pay you late. You know now that you can shire these people because they have the ability to actually repay you. What you really want to know is which 5 companies in my 120-day exposure are really high risk. So in other words, there's been a liquidation application, there's been a SARS judgment of 5 million Rand, et cetera, et cetera, et cetera. Those are the guys that you want to know to immediately stop supplying to because something is going to go wrong, badly wrong, in the next sort of 3 to 6 months. So those are the areas that you want to focus on. Let me quickly open this up. Just give me 1 sec. We are working live here, so I'm just waiting for data to download. Okay, cool. Share. Is it sharing, Fatima? Not yet. Not yet. Why is the screen not sharing now? You are screen sharing. You can't see anything.
I can see it.
Can you see it? Okay, cool. So I presume everybody can see then what I'm showing. Cool. I know this may look complicated, but it's really not. Okay. So over here, we have a wagon wheel that is a risk segmentation representation of your debtors book. Okay. So in this example, we'll see that the client's age analysis that was supplied is 571 million. And we now look at the various risk segmentations of this book. We'll see that 50% of this book is sitting in a low concern, which is cool. But where we want to focus is the 3.7% here and the 10%. So there's about 15% of this debtors book that's currently sitting in a very high risk environment. So in other words, if we're looking at 15% of 571 million, you're looking at a huge amount of money that's potentially at risk, and now you need to interrogate it because you need to understand what is the real risk of these businesses. Number one, staying in business. Number two, having the ability to repay me. Okay. So we have two different risk segmentations. This view here is where we're using open source like public information. Okay. And this is typically a 6 to 12 month view on risk. What is my debtor's probability of paying me or being able to pay me in 6 and 12 months time? That is this risk view. Okay. Then what we've just created about 2 or 3 months ago is because we receive tons and tons of payment profile information on companies or debtors in the market, the way they're paying other creditors. So we've now taken that payment profile information and we've thrown it into this pot. And we call that a delinquency probability indicator. Okay. So what the delinquency probability indicator is showing you, what is my debtor's ability to pay me in the next 30 days? So the first wagon wheel that I showed you is 6 to 12 months. This one is what is my debtor's probability of being able to pay me in the next 30 days, because we're looking at payment profile information. So we're taking all open source public information. We're taking information that we have on your debtors, and then we're throwing in payment profiles to other creditors, throwing that in the pot. We then run 1,000 simulations, and we then give you a view to say, this is what it looks like with regards to your debtors being able to pay you in the next 30 days. You'll see that when we look at a high delinquency probability, if we look at the previous wagon wheel, it was around 15%. So 15% of my debtors, there's a strong likelihood in the next 6 to 12 months that something's going to go pear-shaped. But when we look at the next 30 days, all of a sudden my risk increases to 25%. So in fact, when I'm looking at my debtor's ability to pay me in 30 days, my risk is a lot higher because we're looking at payment profile information. Okay. So let me just go back to the previous wagon wheel. Okay, cool. So what we show you in terms of ticker information or high level information, we look at your balance due versus previous month, past due, debt over credit limit. We look at your weighted average days, and we look at the number of customers that we're looking at. So we've built this tool on Power BI. And what Power BI does is it gives you a great slice and dice capability. So this is high level. Now you want to be able to look at things at a granular level to say, okay, so if this is my group risk, if I wanted to see what the risk profile is of all of my individual subsidiaries, or I wanted to see it by region, by salesperson, or by credit controller, you have the ability to be able to drill down, okay, and then go and have a look, where is the risk originating from and who owns that risk? Because that person that owns the risk or the business unit that owns that risk needs to then help you mitigate that risk. So what you typically would do is quickly click on a filter, and you can now start to slice and dice. Okay, so the example I always like to use is if we look at different metrics, so the balance due, debt over limit, etc., cost of funding, opportunity costs, etc., etc. I like to use the 120-day example. Okay, so I want to look at 120 days. Now we'll see that the values on the wagon wheel has changed. So it's gone from 570 to 94. So I have 94 million Rand on my age analysis that's sitting in 120 days. What is the risk profile of the debtors that make up this exposure? Okay, so we'll see that 57% are in a medium risk profile and 30% are in a low risk. So in this example, these debtors, if there's no credit note issues or queries, they have the ability to pay you. Click on it, and this information will change at the bottom. Credit controller then can immediately see who they need to just hammer harder and actually threaten to list on our database, because we have a listings functionality on our database, and that means that from a trade credit insurance perspective, we have a large distribution network. So most companies will know that those debtors are listed on our database. So when they try and run off and apply for credit elsewhere, there's a very slim chance that they're going to get credit elsewhere. Okay, but what the risk is here is we have 11% of the 94 million Rand is sitting in a very high risk environment. So not only are these debtors paying you late, but I'm also telling you that they're high risk. So bet your bottom dollar, these businesses have gone pear-shaped and they're never going to be able to repay you, as an example. So click on it, you see who they are and you see what the reasons are. You can then start to take proactive action. So this is confirmation that debt has aged on your age analysis. And we're also telling you, not only has this debt aged, but we're telling you that those businesses have become a higher risk profile because of information external to your environment. Okay. So let's just reset this. And the other filters that you can then use, a lot of my clients ask us to do extractions out of this tool on a monthly basis, and we stick it into PowerPoint for them. They then slot that into their board pack from a credit reporting perspective. And so typically they would want their top 10 highest exposures that are high risk, put that into an environment for them, or they would want to see it by business unit, by salesperson, et cetera, et cetera. So what this tool would allow you to do is you would now want to look at different segmentations. So I want to see which branch has the highest risk portfolio, which credit controller, what industry do I have the highest risk exposure to? Okay. You can then choose, I want to see different business statuses. Show me on my debtors ledger who's gone into business rescue that I don't know about, who's gone into voluntary liquidation that I don't know about, et cetera, et cetera. So that's a really cool tool to have. Then you can actually isolate the specific risk categories that you want to view. You can also then look at this from a product perspective. So if you have product codes, I can give you a risk profile by product code, account manager, sales manager, et cetera, et cetera. So let's just close that. And now we can look at by industry, what are my exposures in those industries and what are the risk categories that those particular businesses are falling into. Okay, so if you look at the bottom, you would then be able to see more detail on those specific debtors, okay? So we would see the business status, you would see the credit limit. Then if you insured your book, you would see the insured limit. We then give you the delinquency probability indicator and the risk indicator grading, okay? So often what happens is if you look at the 6 to 12 month risk view, it could be that the business is a low concern. But if you look at your delinquency probability, we may say there's a high delinquency probability. So in other words, if you look at the business fundamentally and structurally, they are sound, okay? But they're not paying creditors on time. So therefore, you can expect not to be paid on time as well. We then give you the major reasons, what's making those particular businesses fall into that particular risk category. Then if you wanted to see any more information on that particular business, you could click on that link. That link will take you to our online database where you can view the credit report that we have on file on that particular business. Okay, so this is really credit risk management on steroids. with a magnifying glass. Okay, so this is the way that businesses need to report, and this is the way that you're going to start to understand which debtors are going to pay me when, etc., etc. Okay, what this tool ultimately can do, if used effectively, it can help you start to reduce your DSOs, the day sales outstanding. On average, how long does it take for my debtors to pay me? And what is the benefit of reducing your DSOs? So whenever a company extends credit, in theory, there's debt somewhere. Okay, so you either borrowed the money or you could have invested the money elsewhere and got a greater return, etc., etc., etc. So one has to look at the time value of money and look at cost of funding. So in other words, if my current DSOs are 90 days, and through this tool, I'm able to reduce exposures to high-risk businesses, I'm able to collect quicker from low-risk businesses. That means that my DSO is reduced by 30 days. And what is the net effect to my bottom line from a cost of funding perspective? So all of a sudden, my cost of funding has a massive reduction, profit margins start to increase, and you start to manage a more profitable, sustainable business at the end of the day. Okay, what we offer here is the ability to have a snapshot and have a look at a 3-month view. Okay, this is really what some of my clients asked us to actually put into this tool. Show me companies where the risk grade has increased 3 months versus current month. So obviously this is because of COVID and lockdown, etc. You can then, each credit controller can have access to their own part of the ledger, and they can then view this over time and say, right, which debtors in January were of a lower risk nature and have now become higher risk. So therefore they need to start to manage those debtors in a very different way. Right, for those analytical people out there, one of my big clients in the telecommunications industry supplied me with 24 months age analysis up front, and they could see now a 24-month view of how risk was changing in different industries at different times of the year. Okay, so this is a very, very powerful tool. Then we have what we call alerts. So every one of our customers supplies us with their master file. We then start to monitor on their debtors what's changing in their debtors environment every single day. Has there been a name change? Have one of the directors, is there a new director? Has somebody got a judgment? Has somebody got a worse bank code? Has Inoxico done a new research credit report, etc., etc.? We feed that information. But what I've created in this tool, this is a monthly risk analysis, is we then give you a consolidated view of all those alerts. So in other words, if you were sitting reviewing a credit controller's performance, and you sit with Cindy and you say, Cindy, right, let's have a look at what negative information occurred on your ledger this month. Ah, I see that you got 2 new judgments. Let's quickly check that you've attended to those. Ah, that's who they are. Okay. You can click on that link. It's going to take you to a physical copy of that judgment. Then you could say, right, which of your debtors, Cindy, has there been new liquidation applications? Oh, there's been none there, but you've got 3 company status changes. So we show you the negative as well as the positive information. Okay, so here you can see there's been six of your debtors, my debtors, have improved from a risk perspective. So sales, please go and sell more to these guys now. There's been 15 positive bank codes on file, etc., etc. Again, this is some analytical information. You can click on filter and you can then start to slice and dice and start to view trends and analysis over time. And then lastly, for all people like myself, in case I forget what things mean, we have a glossary at the end of it that tells you the definition of everything that we've been working with. Okay, so that is pretty much my presentation. I just want to say to everybody that, firstly, thank you for listening to me. And secondly, there is hope, okay? And we have put a lot of time and effort in helping a lot of our very big clients create more profitable and sustainable businesses, especially with regards to finding better quality new business to prospect. We've helped them improve cash flow through these types of tools, and we've helped them to become far more profitable. We've also helped companies understand where their sales guys can go and focus to find better quality business and grow their organizations in a far more sustainable manner. Cool. Open to any questions? No questions. Cool. So we're done. If you want to know anything more about what I've discussed, please feel free to reach out to me. Akila? All right, cool. Thanks, guys. Have a good day. Cheers, cheers.